Hi, Bob.
Hey, Eric. Good to be here with you.
It was nice of Darter to arrange the thunder for a dramatic entry.
Exactly right.
Now, you just came from a pitch contest earlier today.
I did. I was honored to be one of the judges this morning at 9:15. So any of you there at 9:15, congratulations on actually being up. And we sent through we actually saw 6 great pitches, and we sent through a couple of winners.
Yeah.
So it was great.
Tell us anything about the winners?
Well, one was called Care Academy, and one was called Lupe. And Care Academy is focused on the caregivers and trying to create some consistency across that and some ability for online learning in that area for both families and caregivers. And Lupe is doing a very interesting app that tries to drive traffic to restaurants during times when, not the peak times, during those underutilized times. And they're already in 8 markets, so it was pretty good stuff.
Yeah. A thing like this kind of gives you a lot of faith in human ingenuity.
Well, just seeing all the tremendous entrepreneurs, and one of the things I've been able to do a few Facebook Live interviews today, and one of the things that we've been talking about is the amount of women here and the women entrepreneurs that you even see them right here in the crowd. So many of them are growing companies, and we think more and more of them are going to be, imminently successful. We're going to see a much higher percentage of those companies, on our market in the years to come.
Great. Well, that's a great thing to see happen. I want to ask you a question about a warning shot across the bow of private markets, private valuations. It was fired by Bill Gurley last week, Gurley being the VC at
Bill's a friend and one of the most prominent VCs out at Benchmark, and their portfolio has some fantastic companies in it. So when Bill talks, people listen.
Yeah, well, people are certainly listening to this one, in which he said that valuations are doomed to come down, and if you are a highly valued tech company, you should just suck it up because valuations don't go up forever. So the question to you is, what would your advice be to someone who's in possibly a highly valued private company? And the second part of that question is, for those of us in the audience who are not funded, what does it mean? If valuations are headed for a kind of tsunami of down rounds, what's that mean to those of us who are not necessarily in the VC circle?
Well, one thing I'd say to all of you is listen to Bill. He has a blog. He puts out very thoughtful pieces several times a year, and it's free, so just sign up and it'll show up in your inbox. But Bill will tell you some interesting things about what's going on in the Valley and the way he views the world. Another very important thing that we try to remind all entrepreneurs is the fact of when you become a public company, you're not selling your whole company. So your early investors, your venture capitalists, you're not selling your company, you're selling a small portion of your company, and you're going to be there for years to come driving the value of that company, because there's no public market investor that's letting you sell your whole stake at IPO. So it's a small amount of your company. It is hopefully the lowest valuation you ever sell at. So if you continue down the path that now your new investors, those public market investors, mutual funds, pension funds, investment managers have now bought into, if you succeed in the pathway that you have sold to them, you will be imminently successful, and the $10 or $20 that you sell at originally will be that low point in your hopefully public career. So for all of you, I think that number one, yes, I am talking my own book, but the public markets are tremendous currency. They allow you to have access to that for branding, for visibility, for the ability to obviously to do M&A activities, and it gives you a lot of credibility with potential partners, potential anybody who you want to do business with. That public market listing is something that is highly sought after and valued.
Okay. New equity crowdfunding rules go into effect next month. Is that going to revolutionize, or is it going to be another one of those government initiatives that doesn't really go anywhere?
Well, I'd love to take that and just step back and say that some of the government initiatives over the past few years have been very successful. One of them was the Jobs Act, which we just passed our fourth year. So that was in April of 2012. It was the Jobs Act. And the Jobs Act allowed for increased number of shareholders as a private company. You went from 500 shareholders, including employees, to 2,000 shareholders, not including employees. You're able to file confidentially. You were able to push out some of the most taxing areas of Sarbanes-Oxley from 2 to 5 years. And we think that some of the rules that, like that one, in terms of the government initiatives, have been actually very, very positive. I think that everything is always a wait and see. We'll see how the market reacts, but I think in general, they've been more thoughtful in the past few years in terms of how they've engaged and how they've really focused on all of the individuals in this crowd and all that are attending Collision this year, all the great entrepreneurs who are developing the next great revolutionary, disruptive product service to come to market. So, crowdfunding will be an exciting place, I think, for years to come.
Nasdaq has gotten into the private secondary markets as well. How does the Nasdaq private markets work, and how is Nasdaq, what sort of changes have you affected in the model so that it avoids some of the problems, information asymmetry, a lack of disclosure that plagued secondary markets in the first time around?
So philosophically, we at Nasdaq want to support companies from the proverbial two individuals. I think we used to say two guys in a garage, but two individuals, men, women in a garage, creating this great company all the way through, the decades that they're a public company. We've focused really on that public market sector for a long period of time. Then a few years ago, we bought some assets of a company in Silicon Valley. We bought Second Market last fall. We've merged them together to become the largest of the private markets. And in that private market sector, we're able to support companies who are staying private longer. The statistics say you're staying private for 8 or 9 years rather than the 4 or 5 years just a number of years ago when companies were quickly becoming public companies. So with the ability to stay private longer, to raise capital, have more shareholders, all the things that came in under the Jobs Act, companies are staying private longer, and we at Nasdaq want to make sure we're supporting companies as private companies. And what we're doing is we're allowing them to have liquidity events. So we have put together programs so companies, when they're private, can have a liquidity program embedded in their in their plans, their equity plans. It's great for companies who want to both solicit and retain employees. When you have somebody who's getting the same benefit, all benefits, their stock, their salary, everything, but the key differentiator is someone who has signed up for the private market versus someone who hasn't. That company is going to have a much better chance of landing that sought-after engineer because they've already put in place a program to allow them to monetize in the next few years in case that company does take the 8 years to go public. And it's also all about the services. So companies struggle, small companies struggle with things like stock plan administration, cap table analysis, waterfall analysis, all of the things that are embedded in the capital markets part and the financial part of the business sometimes get overlooked. And we're really taking that challenge on ourselves at Nasdaq and trying to support companies as private companies too, as they stay private and then as they transition from private to public.
Okay, all right, well, good. Speaking of that transition from private to public, there's been kind of an IPO drought this year so far. How long do you think that will last, and what will cause it to turn?
Well, we hope that last week's SecureWorks IPO, which was the first tech IPO since December, Atlassian did an IPO, a very successful IPO in early December, and this was the first one. Priced and traded okay on the first couple days. And then we had 2 companies priced last night. Red Rock Resorts priced well, raised $530 million. Chinese financial technology company, Yintech, priced last night. We think that the market is slowly coming to life. This does take a few months and to have some successful IPOs and have the confidence to come back into the market. So it's confidence by sponsors, it's confidence by management teams, and it's confidence by bankers, and bringing all those 3 together. But it does take a little bit of momentum to begin it. The pipeline continues to be very, very strong, though, Eric.
Okay. And so the confidence is confidence that the public markets will be strong, and confidence that the valuations at which these companies will come in will be fair.
Are going to be there, or confidence that that you have to, get yourself public and then keep moving on, because a number of these companies have been either talking about going public. Some of them have done confidential filings. Some of them have even done public filings, and then you kind of sit there and wait, and that anticipation can cause some angst within a company. And so let's get back to working and focusing on our business, but we have to take care of this transaction. So let's take care of this transaction and then move on and sell that small amount of our public currency and get going as a public company.
Okay, all right, good. Well, Bob, I know you've got some important things to say. I will leave you to say them. So
thanks very much. We'll now get ready to do the closing
Thank you,
bell.
everyone.
Thanks, Eric.
Bob.